Hey, do you know how to beat inflation? Because you know what? Inflation is beating you. You make money, right? You got $100. What's happening to that $100 with inflation? And just so you know, inflation is a hidden tax. Let me show you. 1913, if you took your $100 and you looked at the value, it was worth $100. But as we went down all the way to 2019, that $100 because of inflation is only $3.87. How can you beat this? How can you beat a hidden tax called inflation, where it's just taking your money and completely eroding your money so that it's hardly worth anything? Let me show you. Join me now. What's up, everybody? Another week of Wealth Webinar, and today is going to be fire. And it's going to be fire because we're going to be talking about inflation. Anyone been to the grocery store lately? How you liking those prices? Anyone buy a used car lately? That's pretty sweet, huh? Anyone buy anything lately? Like last night, I filled up my truck at the pump, which I haven't done in a while because I've been traveling. And when I filled up, it got up to $85, and I'm like, wait, what the hell? Is it leaking? I'm getting under my truck. I'm like, is this gas just going out the bottom of the tank? Like, when did all this happen? Oh, recently, very recently. Matter of fact, it started when the government started printing money like it's freaking water. So whether it's gas or groceries, or whether it's cars or anything else that you're doing, it costs you more. Guess what inflation is? It's a hidden tax. Oh, but they're not going to tax us. They're only going to tax the rich, the wealthy. They're not going to tax the rest of us. What do you call that? What do you call those price increases? A hidden tax. We are today going to hit inflation dead in the mouth. Like, you know, it's going to be like one of those boxing things, left, right. The right hook is what gets you. And that's what we're going to do. We're going to hit inflation hard. We're not going to just talk about inflation. I think you all know that inflation is a problem. Steven, you know inflation is a problem? Have you heard of that?
Something I heard a little something about inflation.
Yeah, you know, there's just little problem out there. You know, people are talking about it, but you know, it's transitionary, right? Is that what they say? I think it's
transitionary. Right? Nothing to worry about.
Nothing to worry about. It's transitionary. Oh, and then the news headlines on CNBC, I believe it was this week, said, hey, the new reports of inflation just came out and it's down from our anticipated inflation numbers, or our anticipated projections. We thought it was going to be 4.2, give or take a basis point or two, and it's only 4%. Sweet. Inflation's going down. Milk didn't get cheaper. Cheerios aren't any cheaper. Boy, those vegetables don't seem to be getting any cheaper. The gas pump just didn't seem to go down in price, but oh, we're going down. Oh, I'm sorry. You guys don't include food. That's why. Oh, you don't include gas. Shit, I didn't know that. Oh, and you didn't also include housing or rentals. All that stuff's just excluded because, oh, that would mess up the Fed's numbers. We can't include the things that are rampantly going up out of control, but we'll do everything else and we'll just decide what goes in and what doesn't. How do you feel about that, folks? You guys like that? Because that doesn't sit well with me. But hey, listen, you've heard it a million times. If you can't beat them, join them. We're not going to join those bastards, but what we're going to do is we're going to beat them at their own game. If they want inflation to be 4 or 5 or 6%, what we got to do is we got to make our money work harder so that our money actually earns more than 4% or 6% or wherever you believe inflation is based on putting in numbers or extracting numbers. Now we got to decide what is that number we need to beat. And today, I'm going to, number one, show you the impact of inflation because a lot of people don't really understand it, but I drew it for you. And Joseph's going to kind of man the camera. We're going to move the camera around a little bit. We're trying some new things, and we're going to get a bunch more cameras in the studio to actually show you more. But what I want to show you here is I want to show you the purchasing power of $1. Okay. And how we're going to do that is we're going to do that in $100 bills right here. Okay. We're going to look at $100. So all of you understand this, but now I want you to really get the impact since the Federal Reserve was created. And listen, I want all of you to grab a pen and piece of paper, or I want you to remember something. There's a book that you need to read. It's a hard book to read. It's long. Okay. Some of it's dry, but if you really want to understand why you need to read this book, which is 600 pages long, read the last chapter first, and then go back and you will want to read the whole book. The book is called Creature from Jekyll Island. Okay. It is all about the creation of this creature that we call the Fed, the Federal Reserve, which is not owned by the US government. Just so everybody knows, the Federal Reserve is a private entity owned by the wealthiest families in history, one of them probably being the devil, but hey, that depends on what you believe in. But I'm sure he sits on that board too. So the Federal Reserve is a private entity not owned by the government, but technically controls, or as they say, works with the government. So we all understand that. But the Federal Reserve was created in 1913, okay? You know, conveniently, something else was created in 1913. I'm going to give some stuff away today. You guys like free stuff? I've got something really cool. So one of our tenants here, Gary, is moving, and he's kind of got all this stuff that he's done, all these trainings he's done, he's paid a lot of money for it. He's moving, so he gave them to me to give away. So how many of you have ever heard of Ron LeGrand? This is the Godfather right here, right? Ron LeGrand. You guys should hear about this. This book, or this packet, this is a training. So these are all the original trainings. I know we're going back to DVDs. You guys are like, what are those things? I don't even have something to play those. But hey, we're getting back into the retro because we're going back in time. Big money in big chunks. I want to give this away, but how we're going to do it is I'm just going to write your name down, and I'm only going to give 3 things away today. So whoever gets this question right, I will mail this to you Friday, or Gabby will mail this to you Friday. So here's the answer, or the question to get this book, or this packet, or this training manual. Big money in big chunks. What else was created in 1913? Go. What else was created? Okay, Cindy said income tax, federal. What else? Income tax, the tax code. Right. So that was the right. Oh, holy smokes. Just got crazy on me. The tax code. So that was the proper answer. A lot of people were saying the same thing, but Michael, can you just come pick this up? Because you're right here. So Michael Falcone just got this. He's right. The tax code was created in 1913. So it's kind of convenient that they created the tax code and the Federal Reserve right around the same time. And then look what happened after that. See, none of you remember this time frame because none of us were alive. Yeah, that'd be impossible, right? You weren't alive. But let's look at $100 and what the impact was. So in 1913, at the creation of the Federal Reserve, $100 was actually worth $100. Then as we go down, 10-year increments, 1923, $100 was now worth $57.89. Here, I want to share my screen and I want to show you something here. Okay, I want to show you something that'll give you a good visual outside of what I'm showing you right now. So here we go. Can you guys see that right there? Steven, you got that on there?
Yeah.
Perfect. But I got to get rid of these little boxes here because those are in your way. All right. So here is what happened. Federal Reserve was created and look at that. Boom. Whoa. What happened? Well, a lot happened during that period, but we're not going to spend any time. Then that came back up. So in 1933, your $100 would now be worth $76.15. You're like, oh, sweet. You know, it went down to 50 and now it's back up to 70. All right, we're moving in the right direction. But then we get to 1943, which was immediately, well, it was during the Great Depression, but just following the big ass fallout, the dollar started falling again. Okay, so in 1933, it was 76, and that was during the Depression. 1943, it was 57. See what's happening here, 43. We went from here to here, Great Depression. Okay, Bretton Woods Agreement, which, you know, many of you know what that is, some of you don't, not important, but 1953, it went down to 37. So 53, and then we had this long kind of period here where from 53, it was 37, 63, it was 32, 73, it was 22. All right, now, hold on a second. During this period of time, we had the oil crisis. We had the second oil crisis, okay? If you remember, any of you that were alive in the 70s, there were lines miles long at gas stations because they were running out of gas. It was the oil crisis. Then we had the dot-com bubble. Then we had the biggest collapse, you know, the 2008. So let me stop sharing and let's get back to it here. All right, so let's see, just move this and I want you to look at the screen. I want you to remember what happened back in the 80s, okay? Because this is an important thing. I want you to do a little history lesson and I want you to remember what happened from 1973, and we'll just take it to 1993. Remember a little bit of a problem with inflation back then too? Remember, you could buy a house, but your interest rate would have been 10, 13%. Anyone? How many of you remember that? Is anyone here old enough to remember the 70s and early 80s and even into the late 80s? Does anyone remember that?
Yeah, my dad was saying he bought houses in the 80s at 18%, 22% interest rates.
And you could put money in a savings account and get 15%. You could put CDs in and get probably 16, 17%. Hey, Nathan, Deborah, you guys remember that? Jameson remembers that. Yep, bought a house at 14%, Nancy said. Okay, so we got some people that remember this stuff. What drove those interest rates so high during that period? Inflation. Exactly what we're talking about today is exactly the reason that those things were that expensive. But it was just business as usual back then because that was the period of time you were in. But during that time, it didn't feel real good. Okay, there was a lot of problems back in the 70s with the economy, with the markets. It was a mess, but there was a lot of good stuff. So remember, in every down period of time, there's a lot of good that comes out of them too. A reset is not a bad thing. If you actually followed Austrian economics, it's just where they would just allow the markets to rise and fall at their own will. It's the healthiest kind of economy or economic strategy you can be in. But now we've evolved through that Keynesian economics, and now we're in modern monetary theory, where what the government does is just turns the printing press on, literally prints money and prints money and prints money and prints money, and puts little fancy buzzwords like infrastructure stimulus or whatever they call this thing on these different things. But all of this extra money printing will undoubtedly create inflation. It has to. Now, they're doing a pretty good job of kind of keeping that under wraps because they're not including housing, they're not including food, they're not including oil. So if you don't include all these things, it's pretty easy to say, oh, it's only 4%. But at the pump, in the grocery store, out there in the world, it doesn't quite seem like it's 4%. It seems like a lot more. And it's going to get a lot worse before it gets better. So what our job today, Stephen and I, to do is to show you how in 1913, your 100 was worth 100, but yet in 2019, it was worth $3.87. So literally, you took this $100 in that amount of time and you turned it into that little sliver of your $100 magically with a hidden tax. So where did all that money go? Back to the source. Back to the source. Okay, it's always where it goes. You know this. The government creates inflation. It all goes back. The government wants inflation. Make no two ways about it. The government might say, oh, we're trying to curb inflation, this and that. The government wants inflation. Matter of fact, right now, the government is in a little bit of a predicament because the government sort of wants to raise interest rates to curb inflation, but the whiny Wall Street guys, they're crybabies that never shut up. They don't want interest rates to go up because they know what the impact will be on the markets. And the government knows that they really can't raise interest rates. We literally have now backed ourselves into a corner. And that corner is the same corner that Japan got backed into, which led to stagflation and literally like the lost decade. And I don't even think they ever recovered. We're headed there. But there's one thing that's probably going to happen that's going to kind of send all of this into a little bit of a whirlwind. Could happen in a year, could happen in 2 years. We don't know when, but the whole market is eventually going to collapse. It's going to, it has to, just has to. Just look at the charts, look at the wedge. The wedge couldn't be any tighter. And if all of you join us this weekend for the 3-day Money School Essentials training, you will hear from a world leading economist, Harry Dent Jr., in one of the private sessions we're doing, talk to you about how this is inevitable and it has to happen. James Rickard, another leading economist, follow his books, read his books, the next Great Depression. Okay. He talks all about it. They're all saying the same thing, folks, from Michael Burry, okay, to Warren Buffett. He doesn't really say it, but he's not buying anything. Warren Buffett's a bottom feeder. He buys when the market goes down. To, Harry Dent, to James Rickard, name an economist, and I guarantee you they're all saying the same thing. Maybe different ways, different paths, different solutions, but the same thing. When the market collapses, the Fed will immediately pull interest rates because that's just the first lever that they do. I think they got a robot that sits there and does it. They'll pull interest rates. And then once they pull interest rates, now you will enter a world of deflation. Okay, so all of you, and me included, and Stephen included, should love deflation. It means the price of things go down. Think of 2008, 9, 10, 11. Deflation, the price of everything was coming down. Interest rates were coming down. They were curbing, the 2008 Great Recession. That made things cheaper for us to buy. And a lot of us made a lot of money in real estate because we were able to buy real estate assets much cheaper than today. But first, we got to get through inflation that will be followed by deflation sometime in the future. So the problem today is, how do we play this game? Okay. How do we get in the ring with inflation, but yet still prepare for deflation? And there are some ways to do it. It's tricky. I'm not going to make this sound easy. It's not, but there is a way to do it. And that's what we're going to show you. We're going to show you how to beat this game. We can't ever beat it. Your dollars are the most valuable today. They will never be worth more than they are today. Do you guys agree with that? Does anyone think your dollars are going to be worth more in the future? Can I see somebody? So I want you guys to participate. I want to know how many of you think your dollars are going to be worth more in the future. Say I or AYE. Okay. Nope. Nope. So it's safe to say that you all realize, yeah, all right, great. You all realize that your dollars are worth the most today, correct? So if they're worth the most today, we need to protect those dollars, and we need to make sure that those dollars don't ever have to, lose to this inflation. And it's a tricky game. So, there's a lot of people that talk about the solutions to inflation. So how do we actually play the game and beat inflation? So that's what the topic's going to be. It's how do we tactically beat inflation? So I'm going to throw up a whole bunch of things here. And what we're going to do is Stephen and I are going to talk about each one of these things as I put them up. And we're going to move the camera around just so you can get different angles. But see, I wrote them all down. I did my homework. You see, I got kind of mad and I crumpled it up and threw it out. And then I went back and I was literally having a difficult time figuring out, how do you beat inflation, but yet prepare for deflation? And I finally kind of had that realization that you don't, but you can if you do X, Y, and Z. So that's what we're going to talk about. So first thing, I'm just going to hit it with the easiest thing that everybody already knows. Number one way to hedge, okay, inflation is gold. All right, so that is a hedge. I want you to understand this is not beating inflation. All you're doing is hedging against it. Because as the price of the dollar goes down, what happens to the price of gold? Typically, it goes up. But see, here's where you're going to have a hard time with gold. So I'm not saying run out and buy gold. James Rickard would, okay, but he would probably even say right now it's a bit pricey. And the reason for that is we're already kind of past the curve. Everybody realizes that we're in an inflationary period right now. So they've piled money into gold. Big institutions, big hedge funds, pension plans have bulked up on their gold positions to hedge against this. So by you getting in the game of gold right now, you're kind of coming in late, but you still might be able to capture some of that. So gold is a good hedge because the price of gold in an inflationary period, when the dollar becomes worth less, goes up. But what are the problems with tangible physical gold? Where do you put it, right? You go and you buy gold. Like, number one problem is, where do you actually store it? So I'm just going to put storage, okay? Because it is a tangible metal. You got to hang on to it. Secondarily, storage is a problem, but also, how do you exchange it? We don't live back in the ancient Roman times or any of those periods where literally we had gold coins, which you can get today. But I mean, do we just cut slivers off of the gold bars and exchange them? I hate to say, I mean, maybe someday we'll get there, but no time soon. So we got to figure out, like, how do we exchange it? Number three, liquidity. So it's not the most liquid investment, although it can be, because you can easily exchange it to somebody else, but at what price, right? If you buy it today, are you going to exchange it or sell it at a higher price or a lower price? That's a tough one because it's high. All right. So some of these are the problems of gold, but just wanted to put it out there. Gold is a good hedge against inflation. This is kind of common knowledge. I think you guys all knew that. So you're like, wow, you're going to teach me something I don't know? Well, yeah, we're definitely going to. But number two, commodities. Does everybody know what commodities are? Commodities are, I mean, there's a lot of things. They're precious metal, they're beef, they're grains, they're oil, they're like utility companies or electricity. They're things like natural gas. Those are commodities. And the cool thing about commodities is I want you to think about inflation. You're seeing it right now. All of you are seeing this as we speak. Inflation goes up. What else? When the dollar gets weaker, what happens? The price of things go up, doesn't it? You're seeing it. So what price of what things goes up? Commodities, of course. So as we see this inflationary period, we know that if we're going to invest in something, we want to invest in something that we know is going to go up in price, not down. Stocks more than likely are going to go down. So that one we got to be careful with. Crypto, we got to be really careful, although we're going to talk about it. But commodities, more than likely in an inflationary period, will go up in price. So that sounds like a win. So, but what are the problems? And I'm actually going to call them risks. Okay. What are the risks of commodities? Number one, again, liquidity. Okay. You could have a problem with liquidity. Number two, they're very volatile. Okay. Number three, there's a lot of risk in it. There's risk for risk. They fluctuate a lot. They're kind of, they're like crypto. They're always going up, always going down. So like, what price do you buy it at? What price do you sell it at? Do I just hold it? Do I just, it's a difficult one. It's not my favorite. But what I did here is when I was putting this list together, I was thinking, what are the most common things that you would hear in the news or by Googling, or the most common things that you would hear if you read a book? These are the most common hedges against inflation. But none of these are really something that I think, maybe 1 or 5% of you would participate in those two that I just said, but the majority of you would be like, yeah, I just really don't know how to do that. I don't really know how to buy commodities. I don't really want to store gold in the garage or my closet. So like, there's got to be another way. One of my favorites is something that a lot of you are involved in, okay? And that is real estate. Well, we got to be very careful about this one. Number one, I'll be the first to tell you that me and my wife have done lots of real estate. I've done wholesale, I've done hotels, I've done flips, lots of rentals. I've kind of done a little bit of all of it, and I hate it. I can't lie. I really can't. Today, like we were trying to turn the gas on at one of the houses that we just sold. The utility company goes out. They need an 8-hour window. Okay, already pissed off. You're going to make somebody wait there for 8 hours. So it's $100 bill coming out of my pocket to pay someone to sit there and play on their phone for 8 hours. Luckily, somebody went there early. As luck would have it, the utility company plugs their little pressure meter in and says, oh, you got a leak. Sorry. Yeah, see ya. Call us back when you fix this. So then you try to get a plumber. Good luck getting a plumber to do a leak like that. Plumbers are so busy, they don't want to. So, I'm just fed up with real estate. There's always a problem, but I will then say real estate is a really great thing to have in an inflationary period. Look around, folks. If you own real estate now, what has happened to the price of your real estate with this inflation? It's gone up tremendously, hasn't it? If any of you are owning rentals, how many of you have rented a unit in the last, let's just say 4 months? Have any of you rented a unit? Let me hear it. Did anyone rent a unit? Yeah. Okay. So Nancy did. Nancy, did you get more money than you were getting before on that unit you rented? Okay. Christy said hundreds. Mark said yes. All right. So let me just ask all of you, when you're renting these units in the last couple of months, are you asking for more money in rent? And if you're not, I have to ask why. But the answer is yes, absolutely. Rents are up 10% nationwide, more in most places. I mean, like if you were charging somebody $750 in rent, you're probably now charging $900, maybe even $1,000. And you know what? You got a long line of people that want to rent. Every single week, I get some random person emailing me, hey, do you have any units for rent? I don't. I'm fully occupied. And that's the case with a lot of people. Most of us are fully occupied. There's massive demand. There's massive demand because most people that would want to buy a house are now priced out of buying a house. Drives the price of rents up, drives the demand for rent up. So real estate is a hell of a way to not just hedge against inflation, but certainly beat it. Because if all of you are playing the real estate rental game, chances are you're definitely making a pretty good cash on cash return on your money. Some of you are making an infinite return if you've listened to our trainings on how to do that with, using different strategies and the BRRRR strategy to make an infinite return on your money. But you're all doing pretty well, and I can tell. So first off, that's good if you own real estate. But what about those of you that don't own real estate yet? Great. Does this still make sense to beat inflation? It does, because rentals are going to do exactly what we said. But here's the thing you need to be aware of. If you're buying real estate today, which it's very difficult to find deals in this market. If something goes on the MLS, it's going to have 10 to 100 offers, especially if it goes up cheap. And they're doing that now. They're underpricing houses and driving crazy bidding wars. It's just like going to the auction, right? But if you're buying today, chances are you're overpaying for the property. And I don't mean to say that. You might think, oh, I'm not overpaying. It's right in line with comps. Comps are overpriced right now. You are in a speculative bubble with real estate and the stock market. Make no two ways about it. These prices will not hold. Oh, but there's so much demand. So many people want to buy houses. Look at the list. There's not enough houses for the people that want to buy them. True, true, and true. But take away their income, take away the gains from their stock market, take away the gains in their 401k, take away the gains in their crypto. How many buyers are out there clamoring to buy your house with 50 offers on it? Not many, if any. Okay. So you have to understand, if you're buying real estate today, you are overpaying for the property 9 times out of 10. So you're already buying it at the highest point. So the rental really has to make sense. The numbers on the rental have to make sense. Your cap rate better look pretty damn good. If you're buying it today and you're like, well, it covers its expenses, and I think I'm just buying it because I think the price of it's going to go up. Unless you live in Florida, maybe Texas, maybe Salt Lake City, you're kidding yourself. You're literally lying to yourself. Look at yourself in the mirror and say, you liar. If you are, there's no way. There's no way the prices of real estate right now are going to keep going up through what's about to happen. It's not going to happen. You might have a year, maybe another 2 years of increasing prices, but after that, game over. So if you're buying real estate, just be aware that when you want to sell it, if it's in the next 5, maybe 10 years, there's a very high probability you will not get more than what you paid for it. But if you just buy it to hold it, you know, like, I have no intentions on selling, I'm just cash flowing this. It's giddy up and go, man. Get on the horse and get going. Because the rental in real estate, almost always, if you know anything about how it works, will beat inflation. Fair enough. Anyone have any comments on real estate? And also, you know, Christy just made a comment, and I don't know what she was referring to, but this is an important thing. A great way to buy real estate today, a great way, is most of you, you know, that own houses, not all of you own houses. And listen, I think renting a house right now is probably smarter than owning right now. I truly do. Now that's almost, what's that word when someone says something, but they're not doing what they say? Hypocritical. That's hypocritical because I just bought a new house, but I also have a 16-month daughter that sometimes you have to put family in front of logic or things that you believe. So I did just buy a new house, but I did not overpay for it. I'll be the first to say I actually did really well, but that's rare. But I think renting a house right now makes a ton of sense, because I think in 2 to 3 years from now, you're going to be able to buy a house 20 to 30% off. That's just my opinion. So why buy now when you can rent? But the problem is a lot of people are being priced out of rentals. So we got a big problem here with real estate, which means that problem can be solved by you by owning real estate. So anyway, I beat that one up quite a bit, but any comments on that? But what I was getting at is with what Christy said, all of you that have a house, I got down a rabbit hole. Steven, you got to stop me when I do those rabbit hole things. So if you own a house, you have equity in your house. No way you don't. Go to your bank, get a home equity line of credit on that house. And that's money that you literally did not have yesterday. And it's money that literally has been sitting lazy on your couch, doing absolutely nothing while you're out working. So get a home equity line and go out there and try to find yourself a good rental that makes sense by the numbers. That would be a good play. Your lazy money in your house will not be there forever. Think back to 2006 and 2007. Everybody thought, oh my God, my house is just going to keep going up. People were literally living off of the equity in their homes. Truthfully, California, people were living on the equity in their homes, and then it all went away. Great recession kicked in and all that equity gone. Banks pulling lines of credit, freezing lines of credit, not happening anymore. You don't have that money. It's a gift today. That equity in your house is a gift, and you might as well send a thank you letter to not Wall Street. Definitely don't send Wall Street a thank you letter, but send a thank you letter to DC, thanking them for driving so much inflation, driving the price of real estate up, that I just got X amount of equity out of my house, and I'm not going to give it to you. That's what you send them a letter. Don't put your name on it, because then they'll send the auditors out to audit you as to why you're not going to give them that money. But use the equity in your house. Use it to buy real estate. Use it to buy things that are going to get you ahead and get you ready for what's coming. Make sense? If you're not using the equity in your house, I just can't understand why you wouldn't right now. There's too much of it. The rates are too cheap to use the money. And there's nothing, you literally, except for maybe a couple points on your credit score, there is absolutely zero negative part of you like getting into the equity in your house. If you don't use it, you don't pay for it, you have it. And then if an opportunity comes, you can deploy that money and make more. Steven, anything you want to say on home equity lines?
No, not on home equity lines. Somebody did bring something up about house hacking using a 4-unit apartment with an FHA loan. What do you think about that?
I think that's the most fantastic thing. So chances are, and I don't know how old you are, but a lot of younger folks are doing that right now. They're saying, hey, I want to get into the real estate game, but I also need a place to live. So they'll find a duplex or a triplex or a quad. That's the best option, is a quad. They'll make one of the units really nice that they're going to live in, and they'll rent out the other three. And they'll go and they'll get an FHA loan, which is a government-backed loan, okay, Federal Housing Authority loan. And that loan will require them to come out of pocket only 3 or 5%. That's freaking awesome. So they probably have very little money saved, but they can buy a house at these crazy prices. And it doesn't matter because their money out of pocket is so low. They're going to rent out those other 3 units. And those other 3 units are more than going to pay that mortgage, more than going to pay that tax on that house, and probably going to make it so that that house hacker is able to live free and probably maybe even put beer money in their pocket. That's, I think whoever said that, it is a absolutely fantastic idea. It's one that we teach this weekend at the 3-day. And I think anybody that is not doing that, go out there and find something. Find something that you can house hack and make sure the numbers pencil and that will make sense. Love it. Any other questions, Stephen?
No, somebody's just asking about, we're talking about, investing in some of these deals and stuff. They're talking about either REITs or invest with something called FundWise, which I assume is a group thing. So yeah, I mean, that's one way to do. You could go out and develop relationships. Private money lending is very big. We talk a lot about that during the 3-day this weekend. We have the Private Money Club, which I see a lot of people in the chat that are doing deals right now together in the Private Money Club. So yeah, absolutely. I just wanted to bring that up. That's a great way.
Yeah. So let's talk about REITs. A lot of people are like, well, what are REITs? REITs are real estate investment trusts. They come in a couple different flavors. Okay. Well, actually lots of flavors, but there's publicly traded REITs and there's private REITs. When I was, an advisor, we did a lot with both. I hate publicly traded REITs. You don't even know what you're getting into. You don't even know what that REIT is investing in. And most of them trend exactly with the stock market anyway. They're outside of maybe a little bit higher yield, but they're risky because you have no idea what you're getting into. You have no idea how risky that basket of real estate is. Now, private REITs, there was this company called Cole Capital, and I still own it in my self-directed IRA. Cole Capital, it was a commercial private REIT. Okay. It was like they did some strip malls and lots of commercial space, which is rented to like Amazon and places. And I mean, I look today, it hasn't been the best investment, but I've made a solid 5 to 6% since I've had it. And I've had it about 4 years now. The problem with REITs, not publicly traded, but I would never tell you to buy a publicly traded REIT. And if your advisor is suggesting a publicly traded REIT, really dive into the prospectus because you're not going to like what you see. But private REITs can be lucrative. The problem is, again, with REITs, I'm having problems with liquidity. Okay, so, whoop, that's mine. I'm having big problems with liquidity. I want out of the REIT. I have better places to put my money than 5 or 6%. I can't get out. COVID has literally locked the liquidity on my REIT, and I don't know when that's going to free up. I could go in and I can take a small amount out every single month, and every month that number changes, but that's the problem. Like REITs are great, but you're not going to have liquidity. So be very careful. And public REITs, just avoid. All right. Any other questions on that? And someone was asking about VA loans. So if you're a veteran, first off, thank you for your service. Second off, yes, VA loans absolutely will work for house hacking, 100%. All right, let's keep moving because now we're going to get into some fun stuff. All right. So the next thing I'm going to talk about is something that you hear me talk about a lot. You'll hear Harry Dent talk about it a lot, but it would be U.S. Treasury bonds, but not just any U.S. Treasury bond. I'm talking 30 and 40 year, or sorry, 20 and 30. My mistake. I don't know where the 40 came from. I think I'm thinking mortgages. 20 and 30 year U.S. Treasury bonds. Now, as soon as I say that, most of you would look at that and you would say, wait a second, if I buy a 20-year U.S. Treasury bond, do I have to hold that thing 20 years? Absolutely not. You could buy it today and sell it tomorrow. Heck, you can even buy 20+ year U.S. Treasury bonds with an ETF called TLT. This is what I buy. I just sold it because it was going to go down. So I sold it and then I'll buy it back a little bit, but not going to get into that. That'll give you good exposure to 20 and 30 year U.S. Treasury bonds, but also some of you may have heard of TIPS. Okay. I don't mean the tips that you give your waiter. I mean Treasury inflation protected securities. It's another bond issued by the U.S. government that is pretty darn good to keep pace with inflation. So as inflation goes up, TIPS will typically trend with inflation. They're kind of boring, but the cool thing about buying U.S. bonds, okay, bonds from the U.S. government is the liquidity factor. It's the most liquid investment you'll ever buy. If you don't want them, somebody will always, always buy them, because this is the conservative. I mean, US Treasury bonds are backed by the US government. The full-fledged credit and power of the US government is backing it. They've never defaulted on a bond ever. The problem is, you go to your financial advisor and you say, hey, I was just reading or just listening to this thing on this training, and they said we should be buying 20 and 30-year US Treasury bonds. Your advisor is going to tell you that's idiotic. I don't know what happened, but most advisors have forgotten what they learned in the Series 7 stockbroker book. Me and Stephen were talking about this last night. So this is a bit of a repeat if you were on last night's training, but I just want you to understand why you would do this. Okay. This is an X with a circle through it. So this is going to represent the yield you earn. I before E. You guys remember that? I before E always. And I started doing it wrong. So the yield on these right now is about 1.8 to 2.3%. And you're probably thinking, well, that sucks, Chris. You just said inflation is 4 to 6 or 7 or 8 or 9 or 10%. Why would I put my money in something that's only going to pay me 1.8? And your advisor will say the same thing. Your advisor will say, who told you that? Those things only pay 1.8%. You're going to lose money investing in that. Or are you? Because here's the thing you don't understand, and this is what your advisor should understand that they seem to have forgotten, is it's called the inverse relationship to interest rates. So right now, inflation, which we're talking about, is going up. So we're going to draw a little green line, and that line represents inflation. Okay, it's on the move up. What does the US government or the Federal Reserve typically do to combat inflation? Go back to the 1970s and 80s. What did they do? We already talked about it. They raised interest rates. What have they been doing since last year when COVID hit? Raising interest rates. Slowly, very slowly, but they went from close to zero now to 2.3%. So even though you'd think, oh, well, they haven't raised interest rates, they keep saying they're not going to raise them. They have. They have. It's just very slowly. So interest rates are going up. Now, there's a lot more underlying factors, but I just want you to understand, if inflation goes up, interest rates are going to go up. It's always how it's going to work. It's just basic economics. You probably remember it from 5th or 6th grade. They taught this. If interest rates go up, it has an inverse relationship to the price of the US Treasury bonds. The longer the duration, the bigger the impact on the price is. So if you had 30-year Treasury bonds, when interest rates go up, the price of the bond goes down. So pull up 20 and 30-year Treasury bonds and look at a year's price. Okay, look at the price over the year. It's gone down, straight down. Look at TLT, that ETF I talked about, the price has gone down. What does Warren Buffett say to do to make money in investing? What's rule here? Hold on. I want to see who can get this. Ron LeGrand, information on internet marketing and boot camp. Now I'm going to make this a little tougher. I want to know the 2 things that Warren Buffett says that I repeat often. What are they? Okay, so Brad and Jameson got it, but you guys got to give me the rest of it. Okay, so first thing that they do, which is already on the screen, they buy low, sell high, and don't lose money. So neither one of you got that, but I just gave that to you. What else do I always say? Another thing that Warren Buffett says a lot for this packet, this information packet training. Okay, hold, don't sell. Come on, guys and gals. Like, oh, here we go. Someone's getting close. Michael, you got to get the right terminology there. It's close, but you got to finish it. This is a big gift, and it's going to cost probably $5 for me to ship it to you. Come on, what do we got? If poor people knew what the rich do, they wouldn't be poor. That is right, but that's not what I'm looking for. Blood in the water. But Sean, what? There's more to the blood in the water thing. Come on, let's hear it. I need them both, so I need one email. If poor people would just start doing what rich people do, yes, that's what he says, but that's not what I'm looking for. I gave you one. Hold on. What? Be greedy when others are fearful, and fearful for when others are greedy. All right. So Ethan, all I want you to do, Ethan, because I'm going to give it to you anyway. I want you to tell me the other thing that I already repeated. So Warren Buffett says, be greedy when others are fearful, and be fearful when others are greedy. Okay. People right now are greedy, so you should be fearful. But what's the second piece to that I said earlier? And I'll just give it to you. Buy low, sell high, and don't lose money. So congratulations, Ethan. You got that one. All right. So let's come back over here. So if the price of something is going down because of the impacts of what's going on in the economy, i.e. inflation and interest rates, if the price of this is going down, what should we be doing based on what Warren Buffett says? Should we be buying when the price goes down? Yeah, we want to buy as this goes down. So if the price of treasury bonds are going down, we want to start buying them. They're pretty low right now. I just looked this morning. I mean, I'd preferably like to buy that TLT at about 140 to 142, but it's a good price right now. Not a bad investment, not a bad way, but now you're still caught up with this because your advisor says, yeah, but it only makes 1.8 to 2.3. Why would I buy that? Let's flip the switch here. So I'm going to change the color and we're going to flip this around. And now we're going to look at why. Eventually, what's going to happen to inflation? Whoops, what's here? My lines are getting dirty here. So we got to get rid of that. Sorry, getting sloppy. So eventually this is going to change, right? Eventually, what's going to happen to the market? It's going to collapse, right? What is the first thing that happens when the market goes down? I say this all the time. Interest rates go down. The market goes down like it did last year. Just think last year, COVID. When the market tanked, what was the first thing you saw in the news? The government lowered interest rates. Then they lowered interest rates again. They just got that lever. I always say this. I repeat myself a lot, folks, not because I don't think that you know what I'm talking about, because I'm trying to get you to remember. And that's why I give stuff away to try to see if you can recite to me what it is I always repeat over and over and over again. So buy low. Okay, that's what we're going to do. Secondarily, what is the benefit in the end? When things change, the Fed pulls the interest rate lever. When they pull the interest rate lever, what happens to the price of bonds? Now, this you might not know. This is advisor stuff, but your advisor should certainly know this. Stephen knows this, right? Stephen, what happens? When the Fed pulls interest rates, what happens to bonds? Price goes up. Always, every time, the price will go up on bonds. If you own 20-year treasury bonds, and let's just use this. Let's say interest rates go from 2% to 1% or lower.
And Teddy just brought this up, actually. This fits in perfectly. So he said, why did TLT? So TLT is just a way to buy treasury bonds, 20-year treasuries. It's a ticker symbol. It's an easy way to trade them. So he said, why did TLT go down? The market is also down, and all my ETFs also went down, which is different than the last 8 months. But Teddy, what are rates doing right now? Rates, they're increasing rates right now, right?
That's why.
So that is the exact correlation of what you're seeing with TLT going down.
Yeah, and you also sometimes have to remember, like, what you're seeing in the news is old news, okay? The market's already built that in. So a lot of times, like, you'll see something happen and then you'll hear about it in the news and you won't be able to figure it out. It's because the markets are always ahead of you. The information that they're using to base the pricing and everything, it's way ahead. So when you hear or see something happen, it's already built into the market price. So that's why the price is going down. Interest rates are going up. Even though you watch the news and they keep telling you, oh, we're not going to raise interest rates. They are raising interest rates. They have been. And they're going to have to, because if inflation starts going out of control, which indeed it will, it already is, but it's not going to slow down until deflation kicks in, then that's going to happen. So if you were to go from 2 to 1, how much would you make on a 20 or 30-year treasury bond? Well, here, I'm going to give you a range. It's a mathematical equation, but 20 to 40%. The price of your bond, risk-free, would go up 20 to 40%. You'll hear Harry Dent talk about this. It is literally not speculation. It is a mathematical calculation. So how many of you would be okay if you bought something today and then a couple of years, the market tanks and everybody else is losing money and you look at your account and it's up 30%? Would you be okay with that? Risk-free. Risk-free. You got all the liquidity in the world. If you needed that money to buy a car, to fix your roof, sell it. Everybody will buy it. You guys would be okay with that, right? That's the thing. This is U.S. Treasury bonds. Why is your advisor not telling you about this? In most of your 401ks, you should have a government bond fund. It used to be in every 401k. Now, who knows? Now they got these fancy retirement freedom bullshit funds that have 2+% fees, but nobody reads the prospectus. Oh, they don't even mail them to you anymore. Now you just get an email and you're like, 1,002 pages. Yep, I'm not going to read that. Like, that's where all the goodies are. That's where it tells you how much money you're paying in fees. The easier that Wall Street makes it for you, or makes it seem to you, the more expensive it is and the more money they're making. Oh, this freedom fund, it's great. I'm retiring in 2020. I'm retiring in 2040. So I'm going to buy a 2040 retirement fund or freedom fund. And this thing's just going to self-adjust and get more conservative when I get there. Wow, that's easy. I don't have to do a damn thing. Okay. This is just like the government. Government says you don't have to do a damn thing and we'll pay you. Is that free? Absolutely not. Well, it's not free over there either. You think it is. They made it super easy, but because they made it easy, the fees are higher. They're the most expensive funds there are. Just trying to get you to see what's really going on out there. Okay, let's keep going here. You guys got U.S. Treasury bonds and you got tips. So those are some good tips. All right, next. This is where we get into the stuff that me and Steven really love, because this is the stuff you're not going to see in Google. You're not going to see it in Investopedia. You're not going to hear anyone else really talking about it unless you dive a couple layers deep. So now, how do we beat inflation? Super freaking easy to beat inflation doing what we do. Okay, I don't know what number am I on here? 5? We'll just call it 5. Doesn't really matter. The number one way that we will beat inflation is through private lending. Or I'm going to tie this into moving your money. So I want to ask you a question. Where do you lose to inflation? You lose when your money's sitting there earning less than what is going on, what things are going up in price. That's how you lose to inflation. But if your money's always in motion, every 6 months or every year, you're moving it through something and moving it into something and out of something, how can you lose money? You've seen me do the presentation with the bank, right? The circle where, you deposit money, the money gets lent out on a mortgage, then it gets lent out on a car, then a home remodel loan, then credit cards. You've seen that, right? And you see how the interest rate, the spread keeps going up and up and up. It's the bank moving money. Banks don't worry about inflation because their money's in motion. So as one cycle goes or one loan pays back, they're just increasing the rate with inflation, or they're just adjusting it. You can. So my favorite thing is private lending. Okay. On here, I wrote down private secured loans. So we have a whole program called Private Money Club. It's designed exactly for this. Think of eHarmony for dating. Okay. If you guys have ever used eHarmony, I have too. Okay. 2 profiles that come together, a couple messages back and forth. You follow a simple template, boom. You're on the date and you're like, no, that's not going to work out. Or you're like, this could work, right? We did the same thing for private lending. We just said, hey, there's people that have money that want to make more money. Lots of them. And there's a lot of people out there that need money to make more money. So we just said, why don't we just create a community where people that have money and people that need money are together? We'll put the education in the middle so that everybody understands how to do this the proper way. And then we'll put templates and processes in place so that you don't make mistakes. Do X, Y, and Z. You can still make mistakes because you cannot follow the GPS we give you, but you get the point. So we did that. It makes it super easy. It's how I lend my money. It's how Steven lends his money. Heck, we're lending an awful lot of money, but we're not lending any money because we don't get in the middle of your deal. You pay us once per year and you go have fun, man. Go date, go lend money or borrow money. Private lending. How much is our private loans going for today? I'm going to say 8 to 12. But Steven, how much did you saw a couple deals get done in Private Money Club. How much were those deals?
Yeah, there's some people on here right now. They're funding at 15%.
Freaking 15%. Now, hold on a second. If inflation right now is pegged at 4%, you beating inflation at 15? Yep. You beating inflation at 12? Yep. You beating inflation at 8? Yep. Oh, but Chris, there's a lot of risk with that. There is risk, but secured means that there is some tangible asset securing the loan. How about a house? How many of you did you guys hear that I said real estate, renting it could be a pretty good way to beat inflation? So if you're doing this and you own nothing, but you control everything because you are in a first secured position on the loan, own nothing, but control everything, you're getting paid every month in a rate of anywhere between 8 and 15%, which is beating inflation. And then eventually that loan pays off. Brent Kessler, you all know him, Hannah's on here. He just did a loan through Private Money Club to one of our lenders on there. Our lender paid him 12%. And I just got word this morning that loan is closing tomorrow. Literally, they sold the house. His money's been to work for maybe 1 or 2 months. So he only got 2 interest payments at 12% on what he lent. But you know what? That's still better than that money sitting in his bank account. So he'll get that money back in a week or so when the title company mails it to him. And what's he going to do? He's immediately going to move that money again. He's going to go into another deal and he's going to just keep doing that. It's not hard, folks. It's different than what you're used to because you've been lied to your whole life. It's the only reason it's different. Who's been doing this the whole time? The banks and the wealthy. This is all they freaking do. The banks just loan money. They take your money and they loan it out. You can do the same thing. So private lending is absolutely a great way to beat inflation. Any questions on private lending? Yeah, I love it. Everybody, listen, like Jameson and everybody saying, keep it moving, keep it moving. That's exactly it. You lend it, it comes back, you just move it again. But maybe you don't do a private loan. Maybe you do something else. Like it's so freaking cool that you can move your money. But what's another way to move money? Everybody right now wants to talk about crypto. Bitcoin, Ethereum. I'm not going to get into the shit coins, but you get it. Like everybody's talking about this. So how do we use crypto to beat inflation? Well, carefully is the word. So if crypto it trades like this, it's kind of like this. Steven, I don't know if you want to share your screen and show them what crypto actually looks like or what Bitcoin looks like, but it kind of looks like that. Up, down, up, down. It's one of the most volatile investments out there. But the cool part about crypto is it's very predictable lately. And let me define crypto. Bitcoin is what I'm talking about. So we all know, like right now, I think Bitcoin's trending at about $42,000, give or take. Let's see. Where are you at today?
Crypto came down a little. I think it's below 42 right now.
Yeah, I don't know. I'm just trying to get it here. 41,000. So, wow, awesome. Buy some more. So it's at 41,000. Here's what I will tell you. If any of you just know how to look at a chart, very simple. What I want you to do is I want you to literally look at a chart of crypto, of Bitcoin specifically, and it'll kind of look like this. But then what I want you to do is I want you to connect the dots. I want you to draw a line at, like, when you see where it hits 1, 2, 3 times.
There's a 6 month, Chris.
What?
There's a 6 month right here. Oh.
Right. So he's going to put it on the screen, 6 month. Okay. So 6 months, if we were, yeah. So let's see, it's kind of hard because see, this one's kind of got weird numbers, but if we were to draw lines, I'll tell you what it'll say. It'll basically show you 40,000 and 50,000. Okay. We'd probably tighten that thing up, but 40 and 50, that chart would be a good one to look at. And we know that it's been trending. Yes, did it break a little bit through? But yes, but it came back down. But all I'm saying to you is if you want to beat inflation, how I've been doing, and this won't be forever, but right now it's working quite well. I buy at 40. So yesterday I bought, what did I buy? I think $4,000 worth of Bitcoin. And then every week I'm buying 200 of Bitcoin and 200 of Ethereum. I'm dollar cost averaging in. So I'm always buying on the cycle. But I bought $4,000 at right around 40, 41, I think is where I got in. When it hits 50 or 49, I will sell. And if it goes past 50, I won't even look at it. I won't even care. And I'll wait for it to come back down because China bans it, or the US might say, oh, we're going to ban crypto. We're going to ban Bitcoin. Great. It'll come back down to 40. Hell, maybe I'll even get 30 and I'll buy it again. And I'll just keep buying it and selling it, buying it and selling it, and buying it and selling, because I'm too nervous. Like, I'm a nervous Nelly right now because I don't know when this whole thing's going to go down. And I definitely know that crypto is directly correlated or tied to the performance of the stock market. We did this on What the F Happened this morning, where we showed Bitcoin and the, what did we do? Dow or S&P?
The Dow.
Dow. So we looked at 2 charts and literally it was like, wait, am I looking at the exact same damn thing here outside of Bitcoin being more volatile? So can you beat inflation just doing this little strategy? Yeah. Join us this weekend for the 3-day training, which we got a special offer for everybody on here today. And you're going to learn from Spencer, one of the top, in my opinion, crypto guys out there. He's one of the top because he's so hyper focused on how it works, why it's going where it's going, and how to trade it. He might not love this strategy because he buys it and holds it, but I love this strategy because it works. So do you guys like that? Does that make sense to you? It's not hard. You pull up your Coinbase or wherever you're trading, you look, oh, it's at 40. Great. I'll buy a little bit. I'll put $500 in. I'll put $100 in. Okay. And then you look at it another day, you know, I don't know, on lunch break, and oh, wow, it's at 50. Sell. You literally had to spend 30 seconds the one time to click buy, and you had to spend 30 seconds the next time to click sell when it hit 50. It's freaking easy. Not hard at all. So that's a good way to do it, crypto. Okay. But you got to be careful because it's very, very risky. And I always, I always like to say I saved the best for last, but you all know where I'm going next, right? For the last book, for the very last inflation hedge. This is a William Bronchick, Bronchick, Price Reduced Foreclosures, the ultimate guide to short sales and foreclosures investing. How many of you think this will be important coming up here pretty soon? How many of you think short sale and foreclosure investing might be something you want to learn a little bit about? So I'm going to give this one away. And what I want to know is what would be the last inflation hedge or the last inflation beat, what can we use to beat inflation? And what would be that thing that we're going to use? Can somebody tell me what that is? First person gets this. Okay, Jim Collins. See, I keep the questions really, really simple. So Jim Collins, make sure we get your address. You can email it to Steven. You get that. Of course, the infinite banking concept is where I'm going. The infinite banking concept is a banking strategy. How many of you think that the infinite banking concept are those stupid whole life policies? How many of you think that? So just be honest with yourself. How many of you think infinite banking concept is a product? Does anyone? Okay, no, thought they were the same. Okay, yes, sir. All right, I just want to be clear. The infinite banking concept, which was pioneered by a gentleman by the name of a late Nelson Nash, genius man. You should watch his YouTube videos. He wrote the book, Becoming Your Own Banker. All of you, that's a must read, kind of like Rich Dad, Poor Dad. The infinite banking concept is a process. It is a process of mimicking what the banks do in your life, taking back the banking functions in your family and in your life. That process, yes, does need a machine to move the money through, because every banking system needs some type of a machine to move the money through. And what Nelson found and what the banks figured out years ago, and the Rockefellers, the Rothschilds, the JPs, the Morgans, the Ray Krocs, the Walt Disneys, what they all figured out is the best machine or vehicle to run our money through is none other than a specially designed and engineered whole life. But a lot of people, the talking heads or the IUL guys that think they know everything, they think that the whole life is infinite banking. They think that there's no differentiation between the whole life and IBC, and they're totally wrong. The infinite banking concept is just a process that we add the machine to, because it is the only machine that can do what it does, and that is give you uninterrupted compound interest. I'm not here to do an IBC presentation, but I want you to understand that this very well might be, and some would argue with me, and I'm happy to argue it, but this very well might be one of the biggest secrets of the wealthy, bar none. This and 1041 tax reporting and learning how to do trusts and foundations, those two things single-handedly, I would say would be number one and number two, arguably, depending on the person, they'd flip-flop, the two biggest secrets that the wealthy know that you don't. No ifs, ands, or buts about it. The wealthy know a lot of things that you don't, but those two rank the highest, because the infinite banking concept shows you how to actually take back all of the banking functions in your life. In other words, the infinite banking concept can show you how to build wealth through your debts and expenses. The only thing you've done with your debts and expenses is give money to somebody else. The infinite banking concept, very simply and very calculated, shows you how to take that money back. Doesn't happen overnight. That's the problem. That's the biggest problem with the infinite banking concept. Actually, it's the biggest problem with building wealth, is everybody's in a freaking hurry right now. You keep hearing the word FOMO, fear of missing out. That's because everybody's in a damn hurry to get wealthy. Stop being in a hurry, because building wealth, making money, that's the easy part. All of you are good at that. There's not one person on here in the 139 people that is that good at making money. Stephen is very good at making money. Everybody's good at making money. All of you in your right mind and your right ways are good at making money. Do you know what most people suck at? Maybe me and Stephen, not so much. Maybe Hannah, not so much. Keeping it. Show me one person that's really good at making money and really good at keeping it. And then I'll tell you, you found yourself somebody that figured out some things. It's a problem. Until you start trading with rules, you haven't figured out how to keep money. Until you start learning how to hedge your investment positions, you haven't learned how to keep money. Until you learn the different things I showed you with US Treasuries, you haven't learned how to keep your money. You might know how to make it. You might know how to grow it in the stock market or in crypto, but please show me how you're going to keep it if you don't have a plan. You know, what did Mike Tyson say? Joseph, what did Mike Tyson say? Everybody's got a plan until they get punched in the face. That's all of you. And I don't mean to pick on you, but I am here to wake you up. I'm literally here to say, hey, here you go. I've got a red pill and I got a blue pill. Which one do you want? You've seen the Matrix. What one? Pick. You got to make a decision here. You're either going to get on the inside or you're going to always be on the outside. The outside, the cool part about that is it's easy. You just listen to what everybody else tells you. You just follow the sheep. Like it's a piece of cake. You don't have to do anything. So that's cool. And if you want to be on the outside, I don't know why you're here, but that's fine. Like to each their own. But if you want to be on the inside, you know what sucks about it? It's hard. It takes time. It's a marathon. It's not easy. It's a grind. You got to constantly keep working at it. You got to learn new things. You got to apply those new things you learn, which is what my job and Stephen's job and this entire team's job is, to help people solve their money problems by putting them back in control of their money. So the most important thing that you can learn is the infinite banking concept, but the infinite banking concept works the best with a privatized banking policy. That is the machine. And can anyone tell me what the privatized banking policy is? None other than those terrible, awful, horrific life insurance policies called whole life. That's exactly what it is. But It is not the whole life that you buy from your broke-ass brother-in-law. It is not the whole life that you buy from the insurance store. It is a very specially designed and engineered whole life. It's literally built backwards, that is designed to work for banking. And you know who it benefits? You. You know who it doesn't benefit? Your agent, your financial advisor, the person selling it to you. Your advisor will not like you if you tell them to build one of these that gives you more. You say to your advisor or your insurance agent, you say, hey, just saw this thing. I want you to build me a whole life policy, but I want you to build me a specially designed and engineered whole life policy from a mutually owned company that pays dividends. And I want that policy to give me access to 60 to 90% of my money immediately in the first 30 days. Go. Your advisor will look at you and say, oh man, I don't know who told you that, but they were lying to you. That I've heard that's that thing, that scam that I keep hearing about, right? They're lying to you that you can't do that. You can't build a whole life that gives you access to 60 to 90% of your money in the first 30 days. And then you say to your advisor, well, it's not even the first 30 days. It's when my check clears. Oh, see, they're just liars. They just lie. Okay. That's what your advisor says. And number one, your advisor more than likely doesn't know how to do this. 16 years as a high-level advisor, and I was never shown this, never once. I even took my managing partner out to lunch after I left that company. He said, John, I just got to ask you a question. Can I buy you lunch? Sure, Chris, it's been a long time. Let's catch up. His name is John Foster. Took him out to lunch at the brew pub, sat down. I said, John, I just want to know one thing. I was an agent for 14 years with your company. I was one of the top 3 guys. Why did you never teach me about the infinite banking concept and how to design whole lives this way? John, I could have sold so much more. I could have helped so many more people. Why didn't you show this? He knew exactly what it was. He's like, yeah, it's just like bully. You know, when we do this for the banks don't pay commissions. They pay a very small amount. So if we taught you how to do this, most of our new agents have a hard time making it through the first year, let alone sticking around for 5 years. We lose almost everybody. So now all of a sudden I got to go to my agents. I got to say, hey, listen, guys, I'm going to teach you something special. I'm going to teach you about this infinite banking concept, where we're going to design a whole life different than the way we do for life insurance. But that way that we design it is going to give your clients 60 to 90% more cash value immediately in the first days. How many of you guys want to learn this? Everybody's hands go, oh my God, absolutely. John, show me how. And John says, well, hold on, there's a catch. We can do this and I can teach you this, but you all have to agree to something before. And I'm going to make you sign this piece of paper. If you guys want to learn this, can you agree to this? Well, it depends, but yeah, John, what is it? You got to make 60 to 90% less money. Oh, John, I can't do that, man. You got to sign this paper if you guys want to learn how to do this. I bet you 1, maybe 2 of that new org group would sign that paper because they don't want to make 60 to 90% less. Think about it. How many of you want to make 60 to 90% less money than you do today just for helping somebody have 60 to 90% more money? Do any of you want to do that? I mean, in your heart, I know you do, but how many of you could physically do that? Joseph, sucker. Not many, right? None. Jay could, okay. But most people would say, no, I couldn't. I just physically couldn't. I couldn't put a roof over my head. That's what's required. That's what we do. We've just figured out how to help thousands of people doing it. So we make a good living because we serve and help a lot of people. That's it. So the infinite banking concept paired up with that specially designed whole life is single-handedly probably one of the best ways to beat inflation. Why? Because that whole life, if you do this year only, next year, it's a different ballgame. Okay. So I want to be very clear and transparent. What I'm going to put on the board right now and what you're going to hear me say up until probably November of this year ends December 31st, 2021. But right now, the contracts for the whole life pay a guaranteed 4%. This year, 2021, this is being recorded. This will not be 2022 for anyone that starts after. But if you start this year, you're locked in at 4% guaranteed. What is inflation trending at right now? According to the Fed, 4%. So just in a guaranteed, I forgot to mention that, this is guaranteed, just in a guaranteed interest rate that you're paid on that whole life, that would be enough to trend inflation. But we've got some things that come out. We got a cost of insurance that comes out of that. So you're really not going to net 4% in the first couple of years. But I did say building wealth is a marathon. It takes a few years. Plus, these are dividend paying insurance companies. Dividend, got it. Okay, so they pay dividends. And right now, how much are the dividends? I'd say 1.5 to 2%. So if we do 4 plus 2, we're at 6%. So if you're making 6 and inflation is 4, are you beating inflation? Yeah. So right out of the hole, this stupid, terrible whole life insurance policy is already beating inflation. But now the best part is Now, if we take all this, because you guys can understand that, if we say none of that matters, because what really matters is the infinite banking concept. It is what you do with the money you put in here. You put 10,000 in, we're going to take that 10,000 out. We're going to start applying it to other things in your life. We're going to pay off cars. We're going to pay off credit cards. We're going to finance things. We're going to lend money to your company. We're going to buy real estate. All those things you heard me say that beat inflation, we're just going to change where the money goes first. Okay. It's not going to go into somebody else's bank where they win. It's going to go into your bank, which is this. And then what we're going to do is we're going to immediately take that money out and do all the other things that we just talked about. Why? Well, because now you're making money twice, doing the same thing you were doing to make money once. And how many of you want to make money twice instead of once without working any harder, any longer, without taking on any risk and without giving up control of your money? This is why the wealthy use this. This is why banks own more whole life insurance than they do all the land and buildings combined. Look it up, Bank of America, look up Wells Fargo, all factual data. This is what will help you. This is what will beat inflation, or at least hedge inflation. That's my crumpled up piece of paper of the inflation beaters. You now have it, okay? Out of my head, into yours. So what I want to do now is there was a bunch of questions coming in, but I was just so in the moment today that I want to get back to the questions. So one of the questions that came in right around 1:17, so early on, is from Juan, and he said, what is a good way to measure the US dollar strength? Is using the DXY chart a good way to measure it? So the best way to measure the strength of the US dollar is really just compare it against other currencies. DXY would be a good way to do it. But I mean, you can really just go in and, you know, there's the Forex. You could just look and just see where the US dollar is compared to the Canadian dollar or the yen or any other currencies. You could do it that way. But basically, the best way to explain the US dollar, you know, in terms of strength is as long as the US dollar is what they value oil in, the US dollar will be the almighty. If we lose that, we probably will have some big problems with the US dollar. Until then, the US dollar is the almighty, the nicest house in a shitty neighborhood. So you don't really need to worry about the US dollar going to zero like some people, the doomsdayers are, or worry about the US, you know, the US going, you know, and being nothing. Now, not yet. If they keep going at the rate they're going, yes, they're going to destroy this country. But, you know, we can only focus on the now. We can't focus on the past or the future, but we can focus on what's going now, and we can learn from the past to understand where we might be in the future. On this trajectory that we're on, just study Rome, study the Roman Empire, because that would probably be about where we're going. I hate to say it. But right now we're pretty darn good. So hopefully that answers your question, Juan. Cindy said, can you explain zero coupon bonds? I don't like zero coupon bonds. So if you remember the example I gave about the bonds, let's see, let me go back one more. I'll just put it up on the screen. So a zero coupon bond means a lot of times the yield is called a coupon. So a zero coupon bond would just have a 0% coupon. You're still going to have the, you know, the inverse relationships to interest rates. You're going to still be able to capture that upside, but there is no coupon. So, you know, zero coupon bonds aren't really a very popular thing anymore. They used to be. There was some reasons, and that was during, you know, those times when the price of the bonds were going up. But yeah, I would probably stay away from zero coupon bonds unless there's a definitive reason why you're doing it. Juan had another question. He said, how high do you believe they will raise interest rates? I don't know, Juan. It's tough. I personally, this is my opinion only, speculating. I don't think they're going to raise it much more than, you know, maybe 3%. If the government literally has themselves in a little bit of a pickle, they're in a corner. They really can't raise interest rates because the whole system will collapse if they raise interest rates. They know this. If they raise rates to 4%, the whole stock market's going to crash. Okay, so they really can't. So how they've been doing it, just look at the pathway from COVID till now. Super slow, like a little bit here, a basis point, couple basis points, super slow. Nobody notices that. That's how they've been doing it. And that's probably how they will, but they're going to just lie because that's what they seem to do best. They're just going to lie about what inflation numbers really are. And inflation is the driving force, you know, to interest rates going up. So my opinion is they'll just keep lying so that they don't have to raise interest rates, so that the crying baby doesn't keep them up all night long. And the crying baby, if you don't remember, is Wall Street. So that would be my answer to that. But I don't know. That's kind of an unknown. Theodore said, at this point, the best option for my ETFs is to hold. I definitely did not say that. If you own ETFs, I would look at what you paid for the ETFs and where it's at now. And then I would determine, is that the right profit for you? Like, have you made enough money to say, you know what, I'm going to exit here. That's a good point. The only way I would hold ETFs, this is my opinion, I would hold none of the ETFs right now because you're probably doing really well with them. But the only way I would hold ETFs, and I don't know why you would, is if you just absolutely love it. If you literally say, I don't care what this ETF does, I don't care if it loses 40%, I'm in this for the long haul. Well, then you can keep the ETF. But I would always question that whole strategy of buying and holding through this next cycle. If you don't know what you're doing with diversification, I would always struggle to understand why somebody would want to hold something that they know is going to go down to then have to wait for it to come back up, which is going to have to work twice as hard because of the drawdown effect. If you lose 30, you got to make 43% just to get back to 30 and do that. It would just be easier to take your gains off the table, pay a little bit in taxes. Taxes aren't getting cheaper. Pay the taxes, wait for the ETF that you're in now to drop. I just did this, right? I just did it with TLT. My trader sold TLT. I don't know if it was earlier this week or Friday. And then what we're going to do is we're waiting for it to go down because they are raising rates and there's talks of that. So TLT is going down because remember, it's built in. We're just going to buy it back. Like, what did I lose in that? Maybe a little bit in taxes, but you know what, folks, listen, if you're paying taxes, God bless you. Like, you made freaking money. Like, we'll show you ways to kind of not pay as much in taxes, but for crying out loud, don't fear paying taxes. Because if you fear paying taxes today, you are admitting that you're okay paying higher taxes later. That's idiotic. It makes no logical sense outside of somebody somewhere in your life said, oh, just buy and hold. And you know, and just you don't want to pay taxes. So just buy and hold. Now, maybe that works for you. I don't know. So Theodore, I guess it's really to each their own, but I would really look at it and say, does that meet my profit rule? Like, have I made enough money on that ETF? And I would take the profits off the table and, you know, reallocate it into some of these things we talked about that are a lot safer. Juan said, high frequency trading, is this also what you do in your hedge fund? Absolutely. So we have an algorithm, not an algorithm that any of you could ever get your hands on. That algorithm is high frequency trading. Sometimes, I don't know, how many trades go in our hedge fund? A lot. There's a lot. I don't even keep track. You know, it just, the algorithm tells us where to buy and where to sell. Sometimes it's an hour, sometimes it's a couple minutes. Like, we make fractions of a percent, you know, or fractions of a penny sometimes in a trade, but we do that over and over and over again. But our hedge fund is switching gears a little bit, and we are taking private positions in non-publicly traded companies. Like we just took a position, or we are taking a position in a company called Cauliflower, which you've all probably seen at your local grocery store. They make the pizzas that are made out of cauliflower. They make the crackers out of cauliflower. So we jumped in on a private money raise that they're doing for marketing, and then they'll exit that company. So those are really good.
Those are really good too, Chris. Actually, we get those cauliflower
good.
They're great. Yeah.
You think I'm not going to buy into something that I hate? You know, like, hey, we're selling pork rinds. We killed 50 pigs today to make these pork rinds. Oh, sorry, I can't invest in that ethically. But cauliflower, sign me up, baby. And they are damn good. All right. Theodore then asked, how soon will the 3-day event recording be available? So after we're finished on Sunday, Shauna will begin the editing immediately Monday morning, and it usually takes her a day, sometimes 2 days. So I would say by Wednesday, no later than Thursday, you'd have all the edited recordings. We could just send you the recordings, but we like to edit them to make them easier for you to watch. So that would be the answer for that. Unanimous said the 4% guarantee on the specially designed and engineered whole life. Is that fixed for the full life of the policy? Absolutely. Contractually guaranteed for the life of the policy is the answer. Okay. Does that go up with interest rates? Absolutely not. It is fixed for the life of the contract, which is your life. Dividends change. And the cool thing about the banking systems that we do and the private, you know, the whole life policies is we are literally at a 31 or 32 year low on the dividend scales. Dividends definitely trend a little bit with interest rates. So we're at a 30-year low. So if interest rates do go up, like we've been talking, then dividends will go up. And also with them lowering interest rates next year, that'll help a lot. Frank said, what sessions are not being recorded? So the only sessions, Frank, that are not recorded on the 3-day would be the Harry Dent session and then the Solomon. We are not allowed to record Solomons because it is proprietary slides and proprietary information. So that would be Friday and Saturday after the training. So if we finish at what time? 3 o'clock, Stephen?
Yeah, 3:30.
From 3 to 4 p.m. Eastern would be the only times that are not recorded. Hopefully that helps. Theodore said, is there a web page with a link to each of the 3-day bonuses? Yeah, here. I'll just put it up right now. There you go. So I just emailed that to him. Cindy Aiken said, same price for members. Yeah, it's the 197 is the discounted price. That's from Cynthia. She's a member of MSTV. And the anonymous said, so if interest goes up, the loan rate could make you become negative, right? So he's talking about the amount we borrow from the insurance company versus the amount the insurance company pays us with interest and dividends. Could you ever pay more than what you make? I suppose, but listen, like in history, and you can go look, it's never happened. Never happened in my 20 years doing this. I've never even seen it even close. Matter of fact, this is the closest it's ever been with a 1% spread. But back in the day, that spread, interest rates were 5%, you were making 8%. So this is the closest it's ever been at a 1% spread, 6%, and the cost is 5%. But how we're mitigating that right now is so simple. Who's the number one purchaser of whole life in the world? Traditional banks. So traditional banks love whole life. We can assume that that is a yes. And I can tell you that if you have a policy with 25,000 or more in cash value, we could connect you with a bank that specializes in cash value lines of credit in a 1-page application, literally 1 page. And about 2 days, you will probably be approved, unless your credit score is like a 500 or low 6s, you will be approved for a cash value line of credit. And your interest rate to borrow your cash value will be between 3 and 3.5%. So you see, we just fixed the game. If we're making 6 and now we just got our borrow rate down to 3.25, we're doing pretty freaking good. That's what I do. And it allows me to household all my policies into one loan that gives me a checkbook. So
insurance companies are competitive too. So, I mean, I don't know.
Absolutely.
Got to compete, right? I mean,
yeah. Michael, I'm just going to hit this one and then we're going to be done. In the ETF space, if you haven't heard or read of it, the 12% Solution by David Allen Carter. Yeah, I've heard of David Allen Carter, so you guys should read that. ETFs are definitely a million times better. Well, maybe not a million, but they're much, much better than mutual funds. You get a little bit of diversification without the fees of a mutual fund. And you don't get the hanky-panky shit that's going on in mutual funds quite as bad. And I'm not going to get into that, but let's just say mutual funds don't always do what's in your best interest. They do what's in their best interest. But yeah, read that book about ETFs. When we invest, we often do use ETFs to get exposure to the broad-based indexes like the S&P 500, NASDAQ. Pretty much use ETFs for all of it. So there's lots of stuff. There's tons of trading ideas. I don't get into all these fancy trading things. Sodi this weekend on Sunday, I believe, will be teaching you about hedging and an option strategy that you can do. You could do it with ETFs. You can do it with stocks. Doesn't matter. You just can't do it with mutual funds. So we'll teach that at the 3-day. But yes, there's tons of ways to make money. Like I said it earlier, making money is the easy part. Keeping it's the hard part. We want you to keep it, not give it back. Because you've heard it a million times. If you win the lottery, chances are all that money goes back to the same source eventually. It's just a matter of time. They know the game. You just need to beat the game and play the game and mimic them in their exact game. And that's how you get ahead. If you liked that video and that pissed you off a little bit, that your money is literally going out the window to a hidden tax called inflation, well, then you need to learn this video and what it teaches you. So click on that video, check that one out. And also don't forget to subscribe to this channel. And oh yeah, don't forget, smash that alerts button. So every time we put a new video up, you get the notification and you can learn how to beat this ugly game of inflation and how you can learn the truth about money. We'll see you soon.